And if we think back to 2018, all of the volatility that was caused was because of a comment that Powell made about where the neutral rate was and where he thought we were compared to the neutral rate. So our attention is going to start to shift from, okay, they've started cutting, we're over that now. Now, how much are they going to cut and how fast are they going to get there? And that's what will drive markets.
A warm welcome to the On the Tape podcast. Guy Adami, always joined by the lovely Elizabeth Young Thomas. EYT, how are you?
I am well. How are you guys?
I'm outstanding. Of course, Dan Nathan is always here as well. Dan, how are you?
I'm doing great, Guy. Thanks.
Have you been to the state of Wyoming? It's a beautiful state. You know, what's interesting is New Jersey is the most densely populated state. Wyoming is the least densely populated state. Yet this week, a bunch of economists will be out there for something they call Jackson Hole. Have you been out there?
No, well, Jackson Hole is actually the town in Wyoming where all the folks from the Fed are going to be. I have been to Jackson Hole on a few occasions. It is probably one of the most beautiful places in this wide world.
Well, that's where we're going to start, EYT, because, you know, a couple Mondays ago, we had obviously a pretty interesting day in terms of the markets. We had a volatility index that went up to 60. And here on this Monday morning, it appears as though everything is back to normal once again. Yet, I think the story of the week, for me at least, is this Jackson Hole. So let's talk about that. Any expectations? Do you think there's anything market moving that will come out of that?
Well, first of all, I've never been to Wyoming. I think it's one of the 7 states I've never seen. Montana up there too, West Virginia, those little ones. Anywho, yeah, big week, but it doesn't happen till Friday. So we got to get through 4 days before that. I believe there's also a Bank of Japan governor who's going to talk on Friday.
Yes.
So there's a lot happening at the end of this week. We call that back end loaded. I think what we're going to hear from Powell this week, even though we've got a expectation of one cut now priced into the market and only a 25% chance of 50 basis points, I think we're going to hear from him more or less to secure a September cut, but to leave the door open for how big that cut might be, because there's still quite a bit of data. So we'll hear from him, but we've still got another CPI report before that September meeting. We've got another jobs report before that September meeting. There's still a lot that could change the way that this goes. And not to mention, the yen has strengthened quite a bit this morning. So back on that horse.
It's hard to think, Guy, that the data that we're going to see between jobs and CPI is not going to be something that affirms the Fed's decision to, cut 25 basis points at the very least. So if you think about this, we would be going back and forth over the last few weeks is like good news, bad news, what it means for the stock market, right? What it means for yields and the like. And it seems like right now there was one growth scare that happened, August 2nd, 3rd, 4th, 5th, right? We bottom on the 5th. And, we've had a 7-day winning streak, specifically in the NASDAQ. This is the largest, consecutive days of gains and the largest, gain over that period of time that we've seen in a couple of years. And, one of the things that I've gone back to is just like, again, I can't figure it out what's good for the stock market, whether it's weak data, right? And so when I think about the sort of, I heard it expressed like this, the earthquake that we had on that Friday into Monday without any tremors. I'm just looking at some of the kind of the biggest names in the market, whether it's a JP Morgan, whether it's an Eli Lilly, whether it's an Nvidia, they've had these huge rallies back. None of them made new highs, right? So the S&P is still down a couple percent from its highs. And the fact that we don't get Jay Powell speaking until Friday morning makes for kind of maybe a really sleepy week. I don't know, because after those gains, it makes sense that we might consolidate a little bit between now and Friday morning.
Yeah, well, sleepy week for sure. Yet, if you think about it, what Elizabeth just said, and she put out a tweet earlier about the speculative Japanese yen positioning was net 8% bearish as of August 6th, while the unwind and shorts accelerated in early August. Positioning was much more bearish in early July and was down to 36% by July 30th. The unwind carry trade has been going on for quite some time. So, that's been in place, and I think the yen is still a story. But, I keep coming back, EYT, to the fact that, the things that seemingly ailed us a week or 2 weeks or so ago have seemingly been forgotten. And, what I read a lot over the weekend, and you've talked about this, it's when the rate cuts start is when the market gets its most dicey, yet people seem to be championing this as the next catalyst higher for the market. So thoughts on that?
Well, I think the idea is that it's the beginning of monetary policy not being restrictive anymore and then being on a path towards a more supportive and free-flowing monetary system that's on its way to normalization. But you are correct. The first cut is usually not something that we should celebrate, cheer, or hope for to come sooner because it usually does kick off a different type of market environment at the very least. You have some challenges in the market as the yield curve gets more volatile, although this yield curve has been ridiculously volatile, regardless of the fact that we haven't cut yet. And you get some sort of digestive issues in stocks as we try to figure out where that normal rate is, where the neutral rate is, and how far they're going to go, and then how quickly they're going to get there. So the beginning of a cutting cycle, I would say this. The two most important things are when do they start? Because once they start the process, the ball is in motion. And that's why I think they've been hesitant because they know that once they cut the first time, they basically have to keep going. Otherwise, it's going to get confusing for the market. And then the other thing is how quickly do they cut? The market is going to try to figure that out as it goes. And what is that neutral rate? And if we think back to 2018, all of the volatility that was caused was because of a comment that Powell made about where the neutral rate was and where he thought we were compared to the neutral rate. So our attention is going to start to shift from, okay, they've started cutting. We're over that now. Now, how much are they going to cut and how fast are they going to get there? And that's what will drive markets.
Do you think 2018 will be a good analog, let's say, for the balance of 2024 into 2025? Because I think, at the time we were like, okay, the Fed was on what they called autopilot, or at least what a lot of pundits thought. Was it every other meeting? You know what I mean? They were basically raising 25 basis points, right? And then it wasn't until we had a growth scare, right, that they had to kind of do an about face. And so, Guy, I wonder if we're in the exact opposite sort of position. Let's say they go on some sort of glide path for 25 basis points. Let's just say for a handful of meetings, we know that we go from SEP to NOV, right? There's always a couple skips there. And then it really comes down to their communication and then really making sure that they are really ready to move their feet. And I know you hate that, Guy, but ready to move their feet if they get a growth scare. Most importantly here, the economy, the U.S. economy has obviously done a lot better, let's say, than China and Europe over the last few years or so. But again, will there ever be a situation where weakness in China has the potential to kind of permeate or really kind of infect our economy, which for now seems okay, right? It does. I mean, is that fair to say? And I know you're focused on unemployment, but this is, at the time being, that's at least the way I see it.
It is fair that we're probably in better situation at some of the other larger economies in the world, without question. But that doesn't mean we're in a good situation. And what's interesting, I saw that Goldman Sachs, their economists lowered the probability of a U.S. recession in the next year to 20 to 25%. And they were citing retail sales and the jobless claims data, which is interesting, EY, because the jobless claims data is something that you've talked about it as well. That's something we historically don't really talk about it. And I admire them a great deal. But right before our very eyes, you have an unemployment rate that's starting to stair step to the upside. So listen, everybody's entitled to their opinion. I get it. But the things that are flashing red to me for the last year or so are continuing to flash red, even more so now. So again, I'm not an economist. I don't pretend to be one, but I would be absolutely concerned that things are slowing down in a pretty precipitous fashion, and it's slowing down in terms of the job market without question.
Yeah, and those initial claims numbers, what's interesting, you mentioned before, Guy, that the market has seemingly gotten over everything that we were worried about a couple weeks ago. How did we get over it? We got over it with a couple decent initial claims prints and with a good retail sales print. Now, the retail sales print, I would say that's been extrapolated out now into a GDP number for the third quarter. And now people are saying, well, if retail sales are strong, that means the consumer is still strong. Therefore, consumption and GDP might even be stronger than we expect. Therefore, the GDP number shall be strong. That was 1 month out of 3. We've got some more reports to go. So we'll see how that shapes up. But I think that's where we're getting some of these reports of recession being pushed out or recession less likely. Suddenly that growth scare is gone because we got a few prints. Now, the initial claims data, this is interesting for this week. I don't expect this to be a hugely market moving event because it's so after the fact. But we do get revisions on Wednesday for basically jobs added. for a trailing 1 year period, but it ended in March 2024. So that's a little confusing, but we get all of these revisions for that year period from April 2023 to March 2024. And the expectations by economists right now are that we might be revised down by up to 1 million jobs. It could be 500,000 up to 1 million. If it was 500,000 down, that would be, I think, about 20 to 30% lower than what we thought as we were getting all of those prints. So these revisions are important. Now, of course, there's nuances with the data. There's immigration issues. Immigrants evidently are not counted in some of those revisions, so they could be skewed. But still, these are important to listen to because the market has already traded on the reports that have occurred. We revise them quite a bit later, but we might find out that what the market traded on was not as strong as what we expected.
So, Dan, this is interesting because on Friday, and this is somebody that we watch, we'll put it in the show notes, but Bob Elliott was on, I believe, the Overtime show with Morgan, and he talked about the stock market is pricing in a 0% chance of recession in the near term, while the bond market is pricing in a near 100% chance. Bond traders used to be the smart money, but looks like they're getting it wrong again, which, I don't know if he was being sarcastic or not, but there's clearly something going on here. And again, we'll put that in the show notes. But I look at the bond market and say, I still think they're on to something the stock market doesn't seemingly want to pay attention to. And I'm still hard pressed to understand, how quickly we recovered from what should have been a pretty historic event a couple of weeks ago.
Yeah, and let's be frank, that spread between 0% in the stock market and 100% in the bond market, I think we could probably collapse that a great deal to what the reality is, the potential of that. And again, this goes back to my comment before. I mean, we just never know what's going to infect our economy, right? What's going to weaken it. If crude, for instance, goes lower because China's demand is lower, you know what I mean? Is that a net positive for the U.S. consumer? We had consumer confidence data late last week that we didn't, kind of throw on the list of that. That looks pretty good. Guy, you say all the time, consumer confidence is kind of an overlay of the S&P 500. It's just rallied 9% off of a panic low, from a couple weeks ago. We did a very special Monday edition of On the Tape live, if you remember that, because things were so haywire that Monday, and it just feels like there's a relative calm. I'll also throw this out there. I'm looking at the at the money straddle in the SPY. Okay, that's the call premium plus the put premium. You divide it by the at the money strike. You get 1% between now and Friday's close. That is what the options market is implying. So that's why I use that term sleepy between now and then. Liz just mentioned that she doesn't think jobless claims is going to be the sort of mover that we saw a couple of weeks ago. We have some earnings. I'm sure we'll get to that. It's some retailers and some of the high valuation software and security names. I don't think any one of those is going to kind of move the market. So if all we're doing is looking for what Fed Chair Powell is going to say Friday morning and maybe take some indication of what, I can't remember who you said from Japan is speaking, if we have Japan, who the BOJ just kind of didn't about face a little bit on their hawkish take, right? And let's just say the Fed, they don't get overly aggressive on the dovish standpoint, we're kind of at a standstill just from the macro. Does that make sense to you? And then other than, I can't look out and see anything other than NVIDIA, on August 28th to say between now and the end of Labor Day that there's much to derail, what's gone on over the last 2 weeks. That's, listen, you and I think Liz is always looking for glass half full. You and I are often looking glass half empty. And I feel like I'm somewhere right in the middle, at least for the time being, because I can't really see what gets us to new all-time highs, but I can't see us, in the near term, what gets us back to those August 5th lows.
Yeah, and as I say, Elizabeth, I don't want to play stock market with you, but I'll play for a second. And we have some retailers this week, and I'm not asking you to opine on what they're going to do in terms of stock performance. But we have Lowe's tomorrow, we have Target and TJX on Wednesday, and then we have Dollar Tree and Ross Stores on Thursday. So pretty good swath of retailers. But this comes in the wake of what we heard from Walmart, and you go back and listen to the commentary, and again, it was a great quarter for Walmart and the stock acted in kind. But if you listen to what they said, it's again, people that have historically never shopped at Walmart are coming down to Walmart. And that's great for Walmart, but is it great for the economy? What do you think it's saying? I know what I think it's saying about the consumer, the health of the consumer. But what do you think it's saying?
I think Walmart's comments were really important, and we're going to look back on them and say that it was a turning point. Some of the comments that they made about the consumer being very value seeking, and then there was data about how they had done more rollbacks, they had done more specials than they've done before, and those had done really well. It wasn't that they were getting necessarily as many new consumers, but that people were buying more of the stuff. So it helped their results. What you want to hear, if you're bullish, if you are optimistic about GDP growth and you are optimistic about the consumer, what you want to hear this week is a theme that persists through those other retailers. You want to hear the same thing that Walmart said, that we're not worried about an economic downturn pinching our profits towards the end of the year. We're not seeing weakness in the consumer. If you hear that same thing out of Target, you hear that out of Lowe's, you hear that out of Dollar Tree, then that's a theme. But I suspect that we're not going to hear that same thing, especially out of consumer discretionary names as they continue to report. And this really is the time where it's like retail-a-palooza. We're going to get all the data from these big retailers, and you have to search for themes in that. So I think what will probably more likely end up coming out is that Walmart has been eating other retailers' lunch.
And that's what I would say, Dan. You've brought this up as well. It's great. And, I think we try to equate, we being punditry out there, the health of the consumer with some of these retail sales numbers, which arguably were good last week. But then you look in Walmart and say, see, everything's fine. But when you sort of dig down and look underneath the surface, what's happening here is a trade down to Walmart. And then if you think about the lower end, if you look at how poorly these dollar stores have traded, where are they trading? Where is that consumer trading down from? Historically, that's where the trade down goes to, is the lower end. Now it's going from there. So, I look at this and say maybe things aren't as rosy as the stock market sort of suggests.
Yeah, and I guess the point is, through the lens of the stock market, if you just look at, again, Walmart, Home Depot, they're very different names. Home Depot is a far more discretionary, right, than a Walmart. And you think of Walmart as almost a staple. This week, we're going to get Lowe's. We're going to hear what they have to say and see how the stock market does with that. Or Target, you know what I mean? Like, so if those are kind of the ugly redheaded stepchild. Oh, I shouldn't have used that, but you know what I'm saying, of the one versus the other. I mean, I think we're at a place, though, where things are just balancing each other out. And when you think about how, investors reacted to those retailers last week, I mean, I did not expect Walmart to blow out and make a new all-time high. And I would have thought what Home Depot had to say about somewhat cautious guidance, that stock would have been down a little bit. One I think is really interesting is TJ Maxx, that reports, I think, on Thursday. And I think they have clearly benefited. We've seen high-end apparel do poorly. You know what I mean? TJ Maxx is kind of a trade down. It's probably one of the best trade down sort of stories always in the market. That stock has performed very well. So what they have to say might be really interesting to me. Now, I just want to make one other point. You guys were focused on the jobs data and how it might be revised over the last year. This is something that I know a lot of investors have kind of been waiting for. Guy, you've been highlighting, even if it's 1,000 here or 2,000 there, these job cuts, particularly in technology. And there was an article in Bloomberg over the weekend I thought was really interesting. So they're saying that, okay, AI right now is not displacing workers that are doing the job. What's going on right now is that companies are diverting some of the resources that they might, use to kind of increase hiring, or, they're not exactly finding so many efficiencies yet. We've been documenting that over the last few months or so. Lots of CTOs coming out and saying, yeah, it's not really giving us the impetus, you know what I mean, to kind of cut people because they're doing processes. But from a resource standpoint, I think they're getting to a point where they have to weigh CapEx versus jobs. And they don't want to be, if you're like a C-level suite, you don't want to be left behind. So some of those cuts, like we saw at a Cisco, there was also a MasterCard 3% reduction because they want to reallocate resources to higher growth sort of technologies and the like. So that's something that I suspect we see an acceleration of until we see a material guide down by some of these companies saying the demand is just not there for the nuts and bolts, or the, the components of the AI sort of infrastructure build.
Yeah, I agree with that. And, now the terminology is we're trying to improve or enhance efficiencies, which is basically code for layoffs. And EYT, you talk about this all the time. When margins start to be compromised, the first thing to happen is the hiring freeze, and then the next thing to happen is these layoffs. And we're seeing them, I say it all the time, across a swath of different industries, which for whatever reason have not manifested themselves in terms of the rate, although it's starting to, but it's clearly out there for anybody to see and to pay attention to. And this to me is not early cycle stuff. I mean, you talk about this. This is late cycle stuff without question.
Yeah, absolutely. I mean, when you're seeing an unemployment rate rising, you're seeing continuing claims is the indicator that I watch more often than initial claims, even because continuing claims, if they are rising, that means that people have not only become unemployed, but they've stayed unemployed for a longer period of time. And then there are some other thresholds. Once people have been unemployed for 26 weeks or more, that becomes another indicator that's more recessionary. So there are certainly other things to watch out there besides the headline data. And yes, to your point. So once margins get compressed, now look, on the bright side, we came into this with margins at all-time highs, right? So there was plenty of padding for margins to get compressed and for companies to still be okay, even in the face of that. And so far, that has been the case. They've been okay in the face of that. And we've seen a lot of companies, particularly tech companies, cut in the places that they can. And perhaps they were too fat to begin with, so there was room for them to cut. So we've gotten through maybe that first wave of cost cutting, whether it's advertising, marketing, sales, or even personnel that just were not necessary. But as we go forward in the economic cycle, the last thing a CEO wants to do is cut people. Because number one, especially in a job market that now we're sort of scarred by it being so tight, they're tough to replace. And once you cut people, bringing people back on is a difficult thing to do. So the last thing a company wants to do is cut its people. They will wait until the bitter end to have to do that. But if margins get compressed enough, they end up having to do that because it is one of the most expensive components. So if sales slow down, you don't need as many people to support those sales, right? So we'll see that start to happen if things are getting too cool. And it may just be that we get these announcements, we get these headlines, and 1,000 people here and there, 5,000 people, nothing huge. And it might cool the labor market to a point. That's what the Fed is hoping for. That let's say we cool the labor market to a 4.5% unemployment rate, maybe even creeping a little bit closer to 5%, but that it stops there. And the tricky part to me is that I haven't seen it stop there.
Right.
Usually once it starts going up, it does not stop until it gets to a more concerning level.
Yeah, well, let's talk about that quick. I mean, that the fact that they somehow think the same way they thought they could control the inflation rate, they think they can control the unemployment rate. And you've talked about escape velocity many, many times. And I heard Larry Summers talk about this as well. Once this is in motion, it doesn't just stop on a dime. And I think, to me, that's got to be the overarching concern, is that the unemployment rate or the job market, labor market is going to accelerate in a negative way faster than people want to acknowledge, or the market seems to acknowledge as well.
Yeah, look, one of the things that I'm having a lot of trouble with just internally with myself is that when we hear about this data that's weak, things like the SOM rule triggering, the unemployment rate going up more than expected, these job revisions this week that are coming, there's a lot of companies out there, a lot of talkers out there explaining the data away. Things like the SOM rule doesn't really count this time because we started from so low and then we need this other thing to confirm it and it hasn't happened. Or these revisions are coming, but they don't involve immigrants, so it's skewed anyway. We shouldn't look at it. It's starting to feel like the bad data is being explained away too much. Now, I'm not saying that the bad data is suggesting some catastrophe. It's not, but it is suggesting weakness. And we have to acknowledge that it's suggesting weakness, because if we turn a blind eye to that, that's how you get to a point where the stock market and valuations are way out of line with what's actually happening in the real economy. So I think a couple Mondays ago, we got to a much more balanced place where we started to bake in, okay, maybe a soft landing isn't a 100% certainty. It's okay that it's not 100% certainty in the other direction too, but we have to be balanced with what the risks are out there and what the data says that's coming in.
Yeah, I guess what my take on that is, the stock market's not the economy and vice versa, right? So the stock market, we had a bunch of fear put into it, but, again, we have a VIX that's trading now. This is one of the things that we talk about complacency, all the time. It's back at 15 or below 15, right? Which doesn't signify anything particularly, is askew, at least the way investors think about it. But if you think about complacency, you get these sort of growth shocks, or maybe the Fed is a bit more hawkish because some of those inflation readings stop going down in the way in which was giving a lot of investors confidence, right? That we're going to be in this rate cutting cycle. Those are the sorts of things that could cause bouts of volatility. But Liz, I want to hit something that Guy and I talked a little bit last week on Fridays on the tape with Stuart Sopp of Current and obviously Danny Moses. And one of the things that really struck me is that if you look at the Mag 7, and we've been talking about the concentration, we've been talking about the outperformance for a while, it strikes me that there are two outliers from a performance standpoint. One is NVIDIA, which we know is up 150% on the year. No one's going to try to explain that away. We don't need to. I mean, obviously, you might say, well, that's a little aggressive. And then Meta, which is up about 50%. But then you look at the other five. Tesla's down on the year. Apple's up 17% on the year, which is in line with the NASDAQ. Microsoft is up 12% on the year, giving a lot of that outperformance back. So obviously less than what the NASDAQ is up. Look at Google, which is up about 18%. Amazon, which is up 17%. And it's interesting to me when you think about those five basically in line or underperforming the NASDAQ. What happened to that outperformance? What's going to happen? What is the leadership that might take us back through to new highs? I have a hard time putting that together because then if I look at the equal weight S&P, I obviously see massive underperformance relative to the market weight. And then I look at the Russell 2000, which obviously had that little burst of excitement a few weeks ago, you know what I mean, as this kind of, rolling into, or I guess broadening out trade. But it seems like there are very few places that offer that next leg of leadership, which I think we could probably all agree, which speaks to the fact that we should have some digestion. We should have some back and filling until we have better confidence about what 2025, earnings growth rate and sales growth rate looks like. And by the way, just as Goldman put out that report that they're ratcheting down their expectations for a recession 1 year out, they also suggested that revenues, at least consensus revenues for 2025, are too high. They think that consensus, which is 6%, probably comes in more to that 4%, which basically puts us into that whole conversation which you guys just had about margins and the like.
So the question of where does the strength come from? First of all, if the Magnificent Seven is now just the Magnificent Two, obviously somewhere has to pick up the slack. And it's harder for any other sector to pick up that much slack because it just doesn't have as much of a wallop weight-wise. So it needs to come from, in my opinion, cyclical sectors. The cyclical sectors are going to have to carry their weight. And earnings have been decent, so it's possible. It's also going to have to come from consumer names. And we're still on the fence about whether or not that will actually occur. Now, more of those names are going to have to do much better in order to make up for the five that are not pulling the weight that they used to. It's possible, and I think that is a lot of the bull thesis. It is definitely possible for these other sectors to pick up. It requires the economy and GDP growth to stay strong. It requires the job market to stay in check. It requires the Fed's cutting cycle to be gentle. And it basically requires the market itself to not get jittery in the face of, let's say, geopolitical shocks or other data that's coming in. And right now, we are at a place where we are so sensitive to every single data point. I would argue many data points that we shouldn't even be sensitive to. We're so sensitive to it that it just feels like we're too much on edge for that to happen. What I would prefer to happen is that multiples do get compressed a little bit so that we feel more rational in the face of what I think will end up being a different market environment, even if that's not a recessionary market environment.
Elizabeth, before we get out of here, question to you, and this is a leading question, and I should have gone to law school, but the gold market had a huge day on Friday on what was, whatever type of market day, but clearly something is, it's pretty clear to anybody that's paying attention, something's going on here. What do you think it's signaling?
I think it's about currency. I think it's been about currency this whole year. I think that given the strength in the yen, I actually have the gold chart up right now. I'm looking at it for a trailing 1 year period, and it just continues to climb. And it was up marginally today. It's down a little bit now, but the gold market, gold miners, it's everything across the board. And full disclosure, I own GLD, I own PHYS, and I own GDX, which is the gold miners ETF. All of them have done well. And the miners have done particularly well because of some of that catch-up trade. So in an environment where the story is soft landing is still more likely than hard landing, and where we're not worried about the consumer, gold probably should not be climbing like this. And the fact that it is, and the fact that we still have some question marks about the yen and what the Bank of Japan is going to do with rates, and the fact that the dollar is weakening at the same time, tells me that there is still a decent amount of consternation out there in the currency market, and some fear over whether or not we can see that volatility come back and surprise us.
Yeah, Dan, before we get out of here, I agree with her without question. And, I'll say this, if the stock market, if the economy was on as firm footing as it suggests, the gold, to Liz's point, gold wouldn't be having these types of moves in this environment. And, gold's been going, gold was going up with rates going higher. Gold's been going up with rates going lower. Gold's been going up with these currency moves. It's been, outside a couple days here and there, especially a couple Mondays ago when we saw that precipitous sell-off on the back of everything selling off, gold's hung in there like a champ.
Yeah, I mean, the only thing I'd say about gold is that I don't think there's incremental buyers other than what you guys have kind of explained, the increased buying that we see from central banks and then kind of old school investors who, you know what I mean, like love the kind of, dynamics of that sort of investment, as part of their portfolios. I just look at Bitcoin, for instance, because that's the thing that, a lot of younger investors have focused on for similar sort of reasons that, let's say, you and I, when we were coming up in the business, would look to a gold, right? And so look at Bitcoin. It's been a series of lower highs, a series of lower lows. We've talked about the correlation to the Mag 7, if you will. We just talked about some of the underperformance of 5 of those sorts of names. So to me, I like to look at both of them. You have been so right, Guy, for I want to say 2 or 3 years to buy gold on every dip, because incrementally it's made a series of higher lows and a series of higher highs, right? And at some point, if there is a policy mistake, whether it be by the Fed, whether it be by the BOJ, and you could say they've already been made, and that's one of the reasons why it continues to incrementally make new highs, I totally get that. I just don't think there's going to be a rush of adoption by an investor class that did not grow up with this. You know what I'm saying? And that's one of the reasons why I think the volatility in Bitcoin is always interesting to me, because it has become a macro asset. Maybe not of the folks that buy gold or sell gold, you know what I mean? But clearly of this, this newfound investor class, if that makes some sense.
No, it makes sense to me. Elizabeth started this by saying the week was sort of backloaded in terms of the Jackson Hole Fed Chair Powell speech on Friday, but a lot can happen in the interim. We have some earnings, as we mentioned. We have a bunch of other Fed speak along the way. And we have a market that's seemingly on autopilot right now. But I do think, in terms of weeks go, I think this is going to be a pretty important one as we get in the fall. So EYT, you're the best. Dan, Nathan, we will be back tomorrow and a market call. I believe, if I'm not mistaken, Dan, the great Carter Braxton Worth will be joining us. And on Wednesday, EYT of SoFi will be joining us as well.
All right. Thanks, everyone. Thanks, Liz. Thanks to the listener. We appreciate you guys.
Later.